All right. Good evening, good afternoon, good morning, everyone. Thanks for attending the webinar. We'll be covering a lot of stuff during the next 50 minutes, approximately. I will have the chat open for questions and suggestions. So it will be a participative session if you wish. I would like to start looking at some charts. In this case, let me pull up here the trading platform, where we can see this is a 4-hour euro-dollar chart, where you can see the trading activity. I'm showing you this to you in order for you to have a first glance on the type of activity that we are doing here at FX Street with our trading. You can see here, based on the or plotted on the chart, the entries and exits from all the trades. Okay, I'm visualizing this on a 4-hour chart, but it can be it's not dependent on the time frame. It's just for you to visualize and for you to get a first impressions on the type of activity. This is a C-Trader platform account with FX Pro. And for your information, this is a platform which allows hedging. So you will see both long and short positions on the same chart. Yeah. And as you can see here, the arrows, for instance, if I hover here over a long entry, we had here at 0.595 in the euro. We went for 14 pips profit on that trade. But you see that during the life of that particular trade, how deep in negative was the market in between. Okay, and so you have several trades like that one here, also a long entry. Let me see if I can click on it, if it will allow me to see. Okay. As well, a long entry on that spike on the 6th March. It went for a profit of 12 pips. In between, it was probably, I don't know, if 100 pip down or not as much, but in terms of risk-reward relationship, that's what I wanted to start with. You see a pretty negative imbalance between what I'm taking as profits on the table and the amount of risk per trade in some cases. So I would like to start with this aspect, because it's a crucial point to understand the whole thing that we are doing here. This methodology of trading that is mostly a practice of money management and not so much of analyzing markets or trying to time the market in terms of entries and exits. By the time I started formulating the hypothesis to build this methodology, one of the things I've been experiencing was the fact that working with the typical risk-reward ratios of 1 to 2, 1 to 3, which was what I could read and learn from most of the sources I had access to. The experience I drew from that was not at all positive. That is, I realized that in order to time the market, in order to really profit from the market with a risk-reward relationship where you risk a tiny fraction of the potential gain that you aim to achieve, when you work with this type of ratio, you need at the same time either an enormous amount of luck, which can happen. You can have strings of good days or good months, or in some cases, I don't know if a larger period. But in any case, you need or realize at least that you needed some amount of what we would call luck. And if not, you would need a very high level of experience and or a skill in order to profit from the market and not being affected by adverse moves in many of your trades. Posted on the board. Okay, whether we had Jay asking for what the software was we were showing. This is the, one second. This is the C-Trader platform. In this case, we work with FX Pro. It's our partner, and this is where we have the corporate account we are trading. We have started this trading this account in January the 17th, I believe, and this is the trading activity which I was explaining from the beginning. We'll come back here to the platform for more details. Okay. Should a trader be greedy? We have another question. Well, I don't know which definition of greed we would use here, but in any case, we were perhaps I can explain it this way. We were talking about exposure. We were talking about leverage, about the risk control and margin surveillance. So in terms of if we trace some parallels between being greedy and over leveraging, I would say to be careful with the use of leverage. That is, as I was explaining here, the fact that I may use or I may not use stop loss orders per trade in this methodology means also that for each trade I'm not leveraged, or I'm under leverage in for each trade. Right now, you see this is a 10,000 euro account, and we are barely one-to-one leverage. We have an amount of exposure, 8,000 euro on the sell side, 5,000 on the buy side. So it sums up a little more than the account balance. Means we are basically one-to-one or 1 point something leverage. That is compared to what the margin that you are allowed to use with most of retail brokers. This is really a tiny portion, and this doesn't mean that you can't make money not using leverage. You see here the results. We would start looking at all. Yeah, the absolute gain 1.41% in approximately 2 months of trading. We have 1,530 pips accumulated. Our win rate is 96% right now, and this was achieved really with very low leverage. So if you think of the same kind of trading using 2 to 1 or 5 to 1 or 10 to 1 leverage, then you can just multiply the results here, okay, in terms of gain and drawdown as well. Okay, so we started small, and we intend to obviously to increase this leverage. I've been using the same system on a personal account since March, March, I believe it was 2015, and the maximum effective leverage reached using that account was I believe 15 to 1 on 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 a few occasions. Usually I'm around 10 to 1, 10 to 1, 12 to 1 the most. Yeah, um, and still you are able to make money. So in response to the question, if one should be greedy, um, I I think one should be rather smart than greedy. And usually, since everyone is greedy, or the the majority of market participants perhaps are displaying a greedy behavior, you should be doing the opposite. You should be always doing, or at least watching critically what the majority of market participants are doing, not only in terms of forecasts or expectations of future price behavior, but also in terms of techniques used, tools, techniques used, or approaches to the market. So if you see that everyone is using, and this is what we started talking about, if everyone is using a 1 to 3 risk to reward, that is risking a small part to make 3 times more gains, uh, start considering if that is the right thing to do. If everyone is doing that and the majority is losing money, so perhaps you can change that. Perhaps you can formulate an hypothesis that is based on doing the opposite of what everyone is doing. Okay, so it's not going against the crowd or adopting a contrarian view just per se, uh, but questioning everything you see or read or uh, um, you, that others teach you to do, whatever. You should always consider and adopting it to your personal view of the market. NJ asks, is it too much risk to trade in the short term if you are a solo trader? Um, I don't see a risk tied to the time frame. You see, um, markets uh, in some extent have a fractal behavior. That is, if I wouldn't tell you that this is a 4 hour time frame, which I'm displaying here, you wouldn't recognize if it is a 4 hour or 1 minute or a daily chart. Um, so the 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 time horizon, I wouldn't say that is the risky part, but there is something true in your assumption, which I would agree with you that if you are too short-sighted, you may get involved in some risky trading. That's true. Um, what I try to do here, by monitoring each of the legs, the long and the short leg, without stops per trade, but rather monitoring the whole position, yeah, how far it goes against me, the whole position, not a single trade. Uh, I'm giving the market plenty of time to reach to reach for each trade to reach its goals. I still have trades open from 2 years ago, and I still have them open. Yeah, and some of them are in profit. Some of them are in profit, but I use them as part of of the overall hedge. We'll probably will be not talking about the hedge in this session, but just to tell you that the time frame dissolves. I may enter a trade based on a 1 minute chart, and, uh, and perhaps I'm going for 5 pip on that trade, but the trade goes against me. Okay, since that trade is only a tiny fraction of the volume of the margin that I've available, I will not bother if it starts going against me. Okay, the trade can go 200, 500 pip against me, and even if the target was only 5 pip, okay, because that will be part of an entire position, and maybe that trade is going to close for 5 pip 6 months later. In terms of risk reward, or what we usually hear, is this is a terrible relationship, and that trade was, in terms of timing, was, I mean, you couldn't do it worse. I mean, 6 months to achieve 5 pip, but what is that? But the point is that that's why I was showing you the figures here. We have a win rate of 90, in this case 96%. Usually it will drop. On the other account, which is now 2 years old, it dropped to 94. Okay, 94% of the trades close in profit. So this is a very high win rate, and this means that these 5 to 6% of losing trades, these are trades that have been floating in the negative for a long time, and eventually you close them. Okay, and if not, you live with that. You live with that permanent drawdown, and you manage that exposure. But by having such a high win rate, what you are doing is you are increasing your balance constantly. Take this account, for instance. In 2 months time, today we have the 14th. We started January 17th. Okay, so almost 40 days of trading. Okay, 2 months. We have accumulated 1,500 and something pips. Okay, probably we will reach the end of the year with around 10,000 or 20,000, between 10,000 and 20,000 pips. Okay, this is a huge amount of pips, and all these pips, what they are doing is they are adding to your balance, to your to the account. That doesn't mean this is the money that you really have, because the money you really have is the money represented by the equity curve, right? The equity would be the balance minus plus the floating positions. Those positions, either in profit or in loss, which are still open. Okay, and usually this kind of trading will have the equity curve below the balance, and that difference between the balance and equity would be the drawdown. But the drawdown in this type of system is has to be seen not as a drawdown which has to be recovered, like in most other systems, where when you have a drawdown you have to think how to recover from that drawdown. And we know the steps. To recover a 50% drawdown, you need to do 100%. You need to double your account to be break even, right? So if you have a trading method where you go trade by trade, and you have a series of losses, and those losses sum up to a drawdown of 50%, you will barely recover from that. you will, I mean, obviously you can, but statistically, if I would be an investor looking for a money manager and I see a 50% drawdown at some point, I would be very uh, uh, interested in looking how this drawdown was recovered, if it was recovered. Yeah, if it was recovered just in one or two trades, which I then would say, well, that was luck. Yeah, or if it was recovered gradually or whatever. But in this case, it's not about recovering from a drawdown. Yeah, not in the traditional sense, but it's how on one hand, how can I grow the balance so that I can minimize the impact of the floating drawdown? Yeah, and then obviously, on the other hand, how I will manage my exposure on the short and on the long side to reduce that drawdown. Yeah, okay. Uh, so there is a strong component of money management, a very strong component of money management, and a slightly smaller component of tactic, of analytical skill, in order to say, okay, we have the, let's say, I will take a chart here of the euro dollar. Let me put the chart on the screen. And okay, I have a daily chart here. Okay, don't bother for the indicators, but I can so for the component, for the analytical tactical component, I may say, okay, I'm now hedged, and this is the case. I'm slightly more on charge on the sell side. You see, 8,000 euro on the sell side, 5,000 on the buy side. So I'm still overweighting the sell side. Okay, but with this recent breakout on Friday, I may start thinking, if we start moving the euro dollar exchange on this range, 0.6, 0.7, 0.8 eventually, okay, up to the 200 moving average on the daily. On this area, I may say, okay, I will increase the long exposure upwards to 108 or 109 or whatever. If we stay within this realm here, yeah, if we stay within this upper realm here, I will increase the upper, I will increase the long exposure. Okay, so there is a small part of analytical skill of forecasting, that's for sure. But in order to survive, it's really about capturing a lot of pips in order to maintain the balance quite high, and in order to draw the equity curve with it. Okay. Hope I answered more or less the question regarding the time frames or the time horizons. Okay. US account work with this method? Yes, in fact, I'm asking about the first in, first out rule. If there is a way to work with this method, yes. Simply, you have to have two accounts, one for the long exposure, another for the short exposure. Ideally, you choose a broker or agency which allows you to make swaps between the accounts, which are fast. Yeah. And you can circumvent the rule. Obviously, you have one account just for long trades, the other account just for short trades. The only thing, if you want to compose an equity curve or a balance, or the statistics in generally, it becomes a little bit more difficult because you have two accounts. If you want to mingle the statistics into one, it's a bit more of work there. But in the end, it may have its advantages, because since you are going to have so many trades at the same time, eventually having two accounts, it makes it a little bit more visible. Yeah, but for sure it can be done. Yeah. AJ also asks if it is a good idea to make carry trades in the FX market. Well, from my experience and from the experience of others using this approach, is that um, the factoring the carry trade, or let's say using the interest rate differential uh, in this type of method does not necessarily makes you more gains. Yeah, because if you favor the direction of the carry trade, you will be naturally more inclined to have more exposure on the direction of the carry trade, and maybe for other reasons, uh, macroeconomic, technical, pure technical, or whatever, yeah, you may have to go against the carry position, yeah, and load more trades on the side against the carry. So I would not advise to mix both concepts. Yeah, in other trading methods, for sure, you can add it as a plus, so to say. Yeah, but not in. I would not suggest it to do it in this methodology. Okay. So let's go back here to the trading platform. I was explaining in the beginning. I don't know if that was the part where I was cut off, but you see, I have some trades here which aimed for very few pips, like the one I'm hovering right now here. It went for 14.2 pips, 14 pips, but it was deep in the red just after entering the trade. It was not even barely positive in the period thereafter, but it went deeply into positive. So the here we see this risk reward relationship, which is it is negative or against the most typical relationship. And you see trades going for very very few pips, and you see trades going for more pips. You have one here which went for 250 pip, a short trade here. But you have also trades going for 20 or even less here. The one, I may go 5 pip or whatever. Okay, so the point is to let's see. What I've been telling when speaking with people about this methodology is that the method used here to enter and exit the market, this is secondary. Probably the method that you are using right now and the method that many of you may be struggling with, yes, in terms of achieving and consolidating your gains, yeah, can change drastically if you start applying this kind of money management. That is, if you lower the leverage per position, if you eliminate the fixed stops, yeah, if you consider stopping out a trade manually by looking not only at each trade individually, but at the overall position, okay, then uh, probably the method that you are using, yeah, would be of great benefit, yeah, because it's really not it's not really the trading skills in terms of entries and exits which I'm strong at. Yeah? I've induced other people to use this kind of approach, and they had a much finer, much more sophisticated way to trade before they faced this kind of trading, and they got
even better in terms of pip accumulation than my results are showing. So I would not be the best example to teach you how to enter and exit the market. Yeah, and I even encourage you to use your techniques and apply this kind of strategy and, and see how it can change. Yeah, because basically uh, what we are doing here is looking at the market or at the volatility of the market in different ways than the traditional ones. We can look at volatility like we have here, the distance between point A and point B, the distance in the movement in terms of pips, uh, um, independently from what happened in between. Okay, just measure the distance between point A and point B, and that is my measure of volatility. We can also uh, look at the market in terms of an average volatility, an ATR, for example, an average true range. I measure the true range for n period of end periods and make an average out of it. And I have an idea of what is the average per period this market is showing. Okay, I even can use another measure for volatility, which is the measurement between the minimum and maximum within a time horizon. Yeah, uh, these are all measures of volatility. And these measures of volatility, the traditional ones, they measure, in fact, what they are measuring is risk. They are measuring what is the amount of pips, in this case, a market can move against me, right? And but if you start looking uh, at volatility in terms of uh, price movements of a preset threshold, yeah, all these ups and downs in the market, then uh, the the approach to volatility changes from risk to reward. Yeah, what is the amount of pips that the market is displaying? Yeah, uh, in a certain amount of time. How much how many pips did a market go up and down and up and down and up and down, and the sum of all these movements, how much or how many pips did this market display as a potential to be captured? Yeah, and if you measure um, volatility this way, similar to a pointing figure chart. What you see here, this is a pointing figure chart, and uh, in a pointing figure chart, what you do is, this is a very old way to display price behavior, but a very unique one, because you can really display you can have a 1 minute uh, chart um, price action comprising maybe 6 months of 1 minute price movements in a single small chart that can be drawn on your hand. It's really a very clever way um, to display market movements. And this measure, this measure of volatility in terms of thresholds is similar to the construction of point and figure charts, in the sense that um, I will draw an X or an O, depending if the market is going up or down, if the market moves a certain threshold. I will preset that threshold to a certain amount of pips. Let's say in this case, for example, each O and each X is 50 pip. That is, if the market moves 50 pip in one direction, up is an X, down is an O, and it doesn't retrace 50 pip or more, then I will print an X or an O. Yeah. And if the market keeps moving in the same direction, I will print another X or another O on that column. And only if the market retraces by 50 pip or more, I will change column, and I will put a different either an X or an O in a different column. And once I have the chart constructed, I can measure how many boxes, how many X and O of 50 pip threshold did the market move in a certain amount of time. And here we have this ratio, what you see here, 5,200 pip accumulated thresholds of 50 pip movements, ups and downs, ups and downs, ups and downs, compared to a range, yeah, volatility in terms of minimum and maximum, yeah, of 650 pip. So the market had a potential of up and down movements in thresholds of 50 pip 8 times more than it moved below minimum, between minimum and maximum. Yeah. So an euro dollar, and I'm going back to the question about the time frame. If you measure an euro dollar chart on a 1 minute, let's say a 1 minute chart, thresholds of 10 pips, and you sum up the thresholds for an entire year, you will have an incredibly large coastline, what we call coastline, an incredibly large potential of movements. The same movement which we may look at on the daily chart, which we can measure between the low and the high and get a figure of what the potential is in terms of volatility. If you try to start to go into deeper lower time frames and start looking at these ups and down movements displayed there, yeah, the more deeper you go, the smaller the display of the price movements, the larger this line becomes. The larger these lines becomes, and the larger the potential. The larger the potential. So with this trading method, you are looking to accumulate the largest number of pips that you can. And for that, if necessary, you go into the 1 minute chart, if necessary. Okay. The concept of coastline is not coming from the trading arena. This is in geography. It's used to measure coastlines of around the globe. And you see here, if we measure the coastline of the UK in big thresholds, we get a coastline that is much shorter than if we measure the coastline in much smaller thresholds. Yeah. And if we would measure the coastline on the spot, yeah, centimeter by centimeter or inch by inch, then we would get such a large coastline for the UK that you could go several times around the globe. Okay, so the narrower you go, the larger the coastline becomes, the larger the potential. Someone joined late and asks where this is the full method explained. Well, I'm introducing the method here today. I'll be introducing it more times, but where we really go into the details and where we do the live trading is in the premium sessions we have programmed. I think we can share with you a few links. We have a session programmed, I believe, for next week. It's a premium one. There is where we go into the details and we trade live. Okay, but I will be doing also sessions like this one to introduce the methodology in case this is something that you might think it corresponds to the way you see the market, that would fit into your profile, then perfect. Then you can have then more details by going into the premium area. Okay. Let me see if there are more questions on that side. Right now, yeah. May I make a throw a question at the audience? If you have a typical risk reward ratio. We started talking about the risk reward, and it would be interesting to see if this is something that you are considering in your trading, and what is the relationship between your risk and reward. That would be interesting to see. Okay. And it would be also interesting to know where you see the risks of this trading. Yeah. Because there are risks, and these risks can be mitigated by closely following the exposure. Yeah, the exposure for each side. We have right now an exposure of 8,000 euro on the sell side, in respect to 5,000 euro on the buy side. So we are more exposed on the sell side. Yet the market is going up. So as we see here, the equity right now is below the balance. The equity is below the balance, okay, while we have achieved a 140% gain. In real results, we would have made only 1.13. Okay, so there is a floating difference here. And as I said earlier, if the market keeps going higher, I'll be adding to the long position right now. In fact, I was about to take profits around 106, I believe. Let me go to 1 hour. I have a few targets here around the 06 something. Two trades. I think two trades will take profit at these levels. That would reduce the sell side to 6,000, and at the same time I would increase the buy side, so we would stay more or less 100% hedged around these levels. And if we have a recovery towards the 0650, 07, then I would add again to the long side and increase that immediately. I would not wait until we get to higher levels, 0550 or 08, to increase the long exposure. I look forward to increase it earlier. Okay, that's for the for the technical. Okay, I think we are reaching the final part. I don't know if there are more questions. If not, as I said, you are welcome to learn more about this method, trading live on the premium sessions with me. And if not, we'll surely repeat these introductory sessions in the coming weeks. And I thank you very much for the participation, for the questions, and for bearing with me during the technical problems we had at the beginning of the session. Hope it was of interest for you. Hope you can take something home to work with. Any questions, you can contact me via FX Street, and you can also follow our activity on this page, where we have a little bit of explanation to what levels we are watching, and also the trades in real time are posted there. A few charts, a few tools that I'm using to gather market sentiment, to decide which direction to trade, on which levels, and so on. Okay, thank you again, and have a great week, and see you soon. Bye.